Let's say you take a job in London, or you hold dual citizenship and open a savings account in Toronto. You move your life, your family, and naturally, your finances across an international border. You assume you're playing by the rules. Then, usually late at night, you stumble onto a tax forum. You read about U.S. reporting requirements for foreign assets. You see warnings about six-figure fines, seized accounts, and even jail time for holding undeclared money abroad. Panic sets in. If you think you can just keep quiet, you need to understand how the system works today. Thanks to global data sharing agreements, over 100 countries automatically send U.S. account holder data directly to the IRS. They likely already have your foreign account information. We're going to cut through the internet panic. We will look at the actual mathematical risks of noncompliance and map out the specific IRS streamlined procedures that we at Arc and Ledger Accounting use to protect our clients. Ignorance of U.S. tax law won't hold up in an audit as an excuse, but if you act proactively, there are structured legal safe harbors designed to get you back into compliance without losing your life savings. Direct. The confusion starts because non-compliant taxpayers are actually fighting on two separate regulatory fronts. This diagram breaks down the U.S. offshore reporting regime. On the left is the FBAR. This is an anti-money laundering form filed with the Treasury Department. You trigger it the moment your combined foreign accounts exceed $10,000 at any point in the calendar year. Now look at the right side. That's FATCA. This is a tax compliance tool filed directly with the IRS as part of your tax return. It triggers at much higher thresholds, generally starting around $50,000. In the center of this chart, you see the assets that trigger both requirements. Standard checking accounts, foreign mutual funds, and even foreign-issued life insurance policies with a cash value all fall right in the middle. Because these two systems overlap but don't cancel each other out, forgetting to report a single account often means you've committed two separate violations simultaneously, and the fines compound. How the government penalizes those violations depends entirely on one legal distinction: whether your actions were willful or non-willful. A willful violation means you knowingly and intentionally hid offshore assets. The civil penalty for this is severe. The IRS can take the greater of $165,000 or 50% of your account balance for every single year you failed to file. And it extends beyond civil fines. Willful evasion carries significant criminal exposure, including the very real potential for prison time. This is why you cannot attempt a quiet disclosure, which means just quietly filing late forms and hoping nobody notices. The IRS uses AI algorithms specifically designed to flag late filings as willful evasion attempts. On the other side is a non-willful violation. This covers honest mistakes, simple negligence, or a genuine misunderstanding of complex tax laws. The way the government handles these mistakes changed recently. In 2023, the Supreme Court issued a ruling in Bittner v. United States. The ruling clarified how fines are calculated. Non-willful FBAR penalties are now capped at roughly $16,500 per year in total, rather than penalizing you $16,500 for every single unreported account you hold. The Supreme Court lowered the maximum penalty, but the math still adds up quickly. Accumulate a $16,500 fine over 5 unfiled years, and you are staring at an $80,000 bill. Doing nothing is mathematically dangerous. To address this, the IRS created the Streamlined Filing Compliance Procedures. This is the government's official forgiveness program designed specifically for non-willful actors. To enter the program, you have to formally certify that your failure to report your assets was strictly an honest mistake. This requires signing Form 14653 or 14654 under penalty of perjury, plus a detailed narrative explaining why you failed to file. The burden of proof falls entirely on you. Drafting this is highly sensitive. You shouldn't attempt it without a professional team. The program operates on a strict trade-off. You provide the IRS with complete audited financial transparency regarding your offshore accounts, and in exchange, they grant you protection from maximum statutory fines. Once established as non-willful, the IRS categorizes you into two distinct tracks based on residency. First, on the bottom left, is the Streamlined Foreign Offshore Procedures, or SFOP. You file late returns, and the result is total penalty relief, waived to zero. To qualify, you must pass the non-residency test. That means proving you lived outside the U.S. for at least 330 days in a tax year. If you don't meet that test, you fall into the Streamlined Domestic Offshore Procedures, or SDOP. This is for individuals living stateside who already filed their baseline U.S. tax returns but left off their foreign assets. Under SDOP, you avoid the 50% wipeout for willful evasion, but you are required to pay a 5% miscellaneous offshore penalty. This is calculated against the highest aggregate balance of your unreported accounts during the non-compliant period. Your geography dictates the penalty, 0 or 5%, but either track successfully wipes your slate clean and neutralizes the threat of criminal prosecution. Let's look at this decision tree flowchart to help you determine your exact offshore amnesty path. The first note asks, was your violation willful? If you actively hid money using shell companies or offshore trusts to avoid taxes, this process stops here. You need to seek criminal counsel immediately. If it was an honest mistake, we move forward. The next node asks, do you live abroad? Your physical location dictates which of the two final profiles applies to you. If you answer yes, you are looking at Profile 1, which leads to SFOP. This is typically the long-term expat or accidental American who simply didn't realize that citizenship-based taxation followed them overseas. For these taxpayers, SFOP provides a total waiver of penalties, allowing you to bring your record into full compliance without depleting the savings you've built abroad. If you live in the U.S., you follow the other branch to Profile 2, SDOP. This is common for stateside tech workers or business professionals who received foreign equity, stock, or an inheritance but failed to list it on their domestic returns. That 5% penalty serves as a premium for a high-stakes insurance policy. Paying it up front prevents the IRS from seizing half of your account balance during an automated audit. This matrix is rigid. Misdiagnosing your profile or faking non-willfulness will result in immediate rejection from the program and direct prosecution by the IRS. The dividing line between an honest mistake and a willful crime isn't always clear-cut. It is a subjective, legal gray area, determined entirely by the specific facts of your financial history. When six-figure fines and more financial future are on the line, you cannot afford to guess your legal status, and you should never attempt a DIY amnesty filing. Let the professionals handle the math and the legal narrative. Contact Arc and Ledger Accounting in Culver City to authoritatively map your remediation path before the IRS finds the accounts first. Click the link in the video description to schedule your consultation today.